Good morning. Welcome to your Lunch and Learn, Real Estate, Purchasing, and Investing. Thank you all for coming. I really appreciate you coming this morning. My name is Linda Powers. I am a real estate agent from Brookshire, Hathaway, and I have been joined by Margie Schultz from Kellogg Community Credit Union. Later in the program, Margie's going to talk to us about different lending options for purchasing real estate. But for now, I'm going to talk to you about listing and selling, standard retail residential, and also purchasing from an REO or a foreclosure perspective. So again, my name is Linda Powers. I am a 15-year licensed real estate agent in the state of Michigan. I work at Brookshire Hathaway, and I list and sell both standard retail residential, which is regular homes, and then also I specialize in REO. So an REO property is a foreclosure. Currently, we are in a very robust market where we have multiple buyers. Sometimes we have them stacked 3 and 4 deep for every property at all price points. Real estate values, they swing like a pendulum. They go up and down. And so there's never a bad time to jump into investing in real estate. If you look at the graph here, this is the mean and the median graph, and it goes back to 2005. You'll see that the average price of a home in the Battle Creek and surrounding area, these numbers are, BCAR is all the Battle Creek area, so that covers Marshall down to Athens, north into Penfield. But the average sale price back in 2005 was just over $117,000. In 2009, we saw property values hit their bottom. That was at the height of the foreclosure crisis. And ever since then, we've seen a steady increase back up to where we are now in 2017. That same property is now worth $124,000. So not only have we recovered, in many cases, we have seen an increase in those property values. So from a seller's perspective, let's say you've decided to sell your home. Right away you have to start making decisions. How am I going to sell it? For sale by owner or FSBO, or shall I list it with a broker? Let's take a look at both of those. There's one obvious and main advantage to listing FSBO or for sale by owner, and that is potentially it could save you a lot of money because you may not have to pay a commission. However, that's going to come with a price. There are some drawbacks to listing for sale by owner. This is probably going to be the largest single transaction you'll ever make in your life, and there's a lot of risk that goes along with that. You will assume all of that risk. Your marketing opportunities are going to potentially be extremely limited and very, very expensive. Additionally, 34% of all buyers are working with a real estate agent. And so if you're not willing to compensate that agent's probably not willing to bring the buyer to your home. You will do a lot of work in this transaction. So you will screen all of your own buyers, you will set up your own showings, you will host your open houses, you will deal with all of the contractors, the appraisers, possibly attorneys, you will manage the lenders, the title companies, etc. And all of this can be very, very overwhelming if you've never attempted it. So let's say you decide for sale by owner isn't for me, and you'd like to list with a broker. Now what do? How do you find an agent? Well, there's a couple of different ways that you can find an agent. One, ask your friends and family whom they've used. Who have they had a good experience with? Ask for those referrals. Or if you can't find someone that's ever used an agent before, interview agents. It's okay to have 2 or 3 agents over to your home. Interview them, talk about how they practice in specific. This potentially is going to be a long-term relationship, akin to a marriage, really. We're going to be into all aspects of your life, including your finances. And so we all have to get along and be compatible. There are some advantages of listing your home with a broker. Typically, the agents are experts in the local market. We have massive marketing opportunities. For example, when I list your home, as soon as I put it onto the MLS, it's immediately going to go out to over 1,100 other websites. Some are large, some are small. You're going to be on Realtor.com, Trulia.com, Zillow.com, BattleCreekInquirer.com, WallStreetJournal.com. So it goes out to a vast array of websites. When you list your home for sale by owner, you may be missing out on those marketing opportunities. We will provide professional signage and photography, and you'll see on the next slide why that's very important. The agents will deal with all of the parties involved. You strictly keep the house tidy and together and leave the house as soon as there's a showing. Typically, agents tend to get a higher price for the home in a shorter amount of time with better terms. That is what we're paid to do. The next slide shows us where buyers are looking. It's important when we're marketing properties to know where buyers are actually looking for a home. The biggest majority of people are looking for their home on the internet. In fact, 51% of all buyers, that's 51 out of 100 people, are looking for their home on the internet. This is why it's so important to have the biggest presence you possibly can have. Professional photography plays a great role in this. I have a team of photographers that photograph every single home I list. I do an okay job, and I'm sure that many of you could do an okay job photographing your home. These photographers, though, they can take what you have and not make it look like something it isn't, but take what you have and make it look the best it possibly can look. Because as those people are searching on the internet for their home, we need to inspire them somehow to pick up the phone and schedule a showing. The photographs really help us in doing that. 34% of all buyers find their home through their real estate agent. So most of us are working with a certain pool of buyers at any given time. And when we're constantly looking for new houses to come on the market. As soon as one comes on the market, we can call our buyer and say, hey, I need you to look at this, and possibly schedule an appointment. Our yard sign is also key. Brookshire Hathaway has a very large, pretentious sign that sits in your front yard. And there's a reason that it sits up so high. Typically for sale by owners, they have a small sign that they place in the yard. It gets covered up with snow, or when you're mowing the lawn, you take it out, maybe forget to put it back. Sometimes they're just taped in the window. Our signs sit up nice and high so that as people are driving down the road, they can see those signs from a distance. The snowplows are not going to knock them over. We have a team of sign people that if anything should happen to that sign, it becomes dirty or unreadable or broken, they come out and immediately replace it. 4% of all buyers find their home through a friend, a relative, or a neighbor. And then 4% find it through another means. This is a flow chart of the process for selling a home. Now, this is my job description, and this is how I earn my commission. Not every one of these steps may apply to your specific transaction. For example, if you live within city limits, you're probably on municipal utilities, so you're not going to have a well and septic inspection. But potentially, these are all of the steps from start to finish in buying and selling a home. It is key to get the pricing correct. And so we're going to work very hard together in getting the proper pricing on the home. So when you call and you ask me to come out to list your home, it's typically a two-step process. We can sometimes do them in a one-step process, but a two-step process is really a more thorough process. I'm going to ask you to show me the home as if you were trying to sell it to me, and I'm going to look at the home through the eyes of a buyer. What is the buyer looking at? Are they looking at that red wall and not focusing on the rest of the house? Are they looking at the clutter on the desk? We need them to focus not on your stuff, but on the house. And so I need to determine what is it we need to do to condition this house. I'm going to create a honey-do list or a wish list. This wish list is going to be items of, these are the things we wish we could do to condition the house if we had the time, the money, and the desire. Additionally, most importantly, are your goals. I need to interview you to find out, what are your goals in selling this home? How quickly do you want to sell this home? because there is a price at which every home will sell. There's a 30-day price, and that could be very different from the 120 or 180-day price. There is an as-is price. If you said, I don't have any money or any time to condition this home, I need to sell it as is, but that price could be very different than the repaired price. On the next side, this demonstrates where we should price the house. My goal for you as a seller is to price your home at fair market value, right in the middle. And you see to the right of the chart, that is where we're going to get the best average number of buyers to come through your home. And then we're going to get the best offers. If we go up in price by 5 or even 10%, you see on the right what happens to the number of lookers. The number of buyers that will actually come through your home, the foot traffic, will decrease significantly. If we get up too high in price, you're going to actually see nobody comes through the house. And if no one is coming through the house, we're not going to get any offers. Conversely, if we underprice the home by 5 or 10%, you see what happens to the number of buyers. The foot traffic actually increases. But you get down into that 10% range below fair market value, and you're getting into your investor range where they're going to lowball you, you're going to feel insulted, and we're probably not going to come to terms. So ideally, you should be at fair market value or even 1 to 2% under fair market value. At 1 to 2% under fair market value, this is the range where we see multiple offers for sellers. So we can pit buyers against each other and raise the prices or get better terms. Next, let's talk about conditioning. So from a bank or an REO perspective, they learned very quickly in the whole foreclosure process that if they put just a little bit of money into their homes, they could attract owner-occupants, they could help stabilize neighborhoods, and they could get more money for their homes. And so they decided they're going to invest money into repairing these homes. Now, some people, when they lost their homes to foreclosure, were very, very angry. And they would rip ceiling fans out of the wall, they would steal the toilets, or they would smash the fixtures. So to attract those owner-occupants, they learned that they have to repair these homes. There's no amount of money that they won't spend on a home. There isn't a standard limit that they won't spend on rehabbing a home. As long as it makes sense to do it, they will do it. If you're selling your home, you have to realize as a standard retail seller that you're going to be competing with these foreclosures, and you should do something to condition your homes too. The next set of slides are some examples of projects that I've worked on. This first home, and these are all foreclosures, this first home was just south of Beetle Lake, and it was a very large home, and it was very unfinished. They ran out of money and were living in it in an unfinished state. And so when I took possession of the home, we made a determination that we needed to fix this home up in order to capitalize on the beautiful house that it was. There were 20 tons of hardwood floors throughout this house. We finished every last one of them. The countertops were actually plywood. There weren't any countertops on at all. On the right, we put the countertops on. We ordered stainless steel appliances, put a new cooktop in. It's tough to see in this picture, but we did put a new cooktop in, a new dishwasher, and we did leave the refrigerator. Put all new light fixtures throughout this home. We actually put over $50,000 into this home. This was just one small snapshot of what we did here. This next project I worked on the house wasn't bad itself, but it had this pool, an in-the-ground pool. The trees were growing out of it, the liner was ripped, the sides were collapsing in, and it was a nice $130,000 home in a nice neighborhood. We made the decision to take that pool out of there, so that's exactly what we did. We crushed it up, and we hauled it out of there. We did not bury it. We took all of the components of the pool out, and you can see in the bottom right corner, we had a more functional yard. It was a large yard, and someone with kids could really enjoy that. The last slide, this is a home that I actually have on the market now. When I took possession of this home, it was in average condition. It was a little tired and sort of boring. The kitchen was an okay galley-style kitchen. The cabinets were original to the house. It was built in about 1976. They had that brown laminate strip on it. They were laminate on the outside. The countertops were very plain. There was nothing that said wow in this kitchen. And so we put about $5,000 into the kitchen. We replaced all of the appliances with stainless steel, put new countertops on. They were not granite, they were a laminate, but they were fresh and clean. There were no marks on them. Actually we painted the whole house, but we neutralized the kitchen, and we installed new uppers and lowers. There's also a peninsula in the back there that we replaced so that it matched the countertops. We have that one under contract, almost full price, with an owner-occupant. From an REO perspective, Fannie Mae and Freddie Mac, the two big banks that insure mortgages, their primary goal is to sell to an owner-occupant rather than an investor. They learned very early on in the process that owner-occupants would stabilize neighborhoods because they would maintain their houses better. They would put more money into their homes. And having owner-occupants in houses helped raise values across the neighborhood. They believed so much in bringing owner-occupants back into neighborhoods that what they do is they have this first look period. And if you're in the market and you're looking at a foreclosure, and the foreclosure bank is one of the big three, Fannie Mae, Freddie Mac, or HUD, they all have this first look period. The first look period is a period of time. With Fannie Mae, it's 20 days. The first 20 days of the listing, they will look at only owner-occupant offers. On the 21st day and every day thereafter, they will look at all offers. But they really want to reserve the first several weeks for owner-occupants only. So let's talk about overpricing a house. I'm going to look at the neighborhood as a whole and see what the property values are on average, and how does your home compare to the rest of the neighborhood. If the range of property values in your neighborhood is, let's say, between 140 and 160, meaning the average price is 150, I have to determine where off of average is your home. If I give you the information that your home is smack dab in the middle, $150,000, and you decide to list it at $175,000, you may be shooting yourself in the foot. Because if you're overpricing it, you're probably overconditioning it, and you're most likely going to leave money on the table. So if there's a buyer out there who's a $150,000 buyer, and they're looking on the internet for a $150,000 house, which your house may be, they're not going to see it at $175, and you've just missed the buyer. Another buyer will eventually come along, but it may take some time. Regarding overpricing, the first 3 weeks of the listing, we are going to see a lot of traffic on the internet. We have counters and ways of knowing who is saving the listing to their favorite, who is opening the listing up and looking at additional statistics on the house, who's emailing the listings. We have a lot of counters on our listings, and we know that in the first 3 weeks of the listing is we're going to see the most traffic from buyers. If we are out of range too far with our marketing plan, you may be missing that buyer. What will happen is marketing time for your property is going to be longer. You may take less money in the end. And most importantly, if there's financing involved, the bank is going to send an appraiser through the house. Now, an appraiser is someone who's going to put an independent opinion of value on the house. If the appraiser says, let's say we were lucky enough to get our house under contract at $170,000, but the appraiser now says the house is only worth $155,000, we have a real issue. Either we're going to have to reduce the price down to the appraised price, or we have a dead deal. This next slide shows, it's a funny picture of how different people see the value of a house. In the upper left-hand corner, you see how you would view your home. It's a very well-maintained home. It has nice curb appeal. Everybody would want that home. The buyer is going to see it as a shack. They're going to try to lowball you on your offers. The appraiser, you're going to wonder if they'd even been through the house. The inspector, they're going to nitpick every last little item in that house. And the tax assessor, of course, is going to see it as the Taj Mahal. So market value. There are definitely some things that get a house sold. Condition, pricing, location, amenities, things like that. Those are the things that actually sell houses. What doesn't sell a house? If you said to me, I owe $10,000 on my credit card and I would like to clear that credit card from the proceeds of the sale of my house. Your credit card debt does not drive sale price. If I knew how much you paid for the house or how much you even owe on the house, none of that has any bearing on sale price. Those things don't drive the market. A home is worth what one buyer is willing to pay at any given point in time, and it has nothing to do with what you'd like to get or what you owe on the house. So how do we actually determine the value of your home? I'm going to do for you what's called a CMA, or a comparative market analysis, and it looks a little bit like an appraisal. Although I am not a licensed appraiser, it does look like one. And we're going to look at a couple of different things. The first thing I want to know is, what is your competition? So I'm going to go out in your neighborhood and I'm going to look at who is actively on the market right now. And like a box of cereal on the shelf at the grocery store, I have to determine where am I going to place your box so that we can most fairly compete with the other boxes, because I want a buyer to choose your box first. More importantly, though, I want to go into your neighborhood and look at what has sold. The sold comparables tell us from the buyers, this is the buyers speaking to the market. This is what a buyer is willing to pay for a home like yours in your neighborhood. But there are no two houses that are identical, right? So we have to have a way to adjust some things. This is an example of a market analysis, and the first column, the gray column to the left, is the subject property. And we want to compare all the same items. So I listed out the important key items that create value in a home. I found 3 comparables. The subject was a 2-story traditional style home built in 1920. It was in Hastings, and I found 3 other homes in Hastings that were 2-story, built about the same vintage. They had similar bedrooms, bathroom counts, things like that. So if you look at the first comp, you'll see about halfway down, you see the year built. The subject was 1920. The comp was built in 1873, so there's 53 years difference. And if we think about this, the subject was built up here in 1920. The comp was built in 1873. It's inferior to the subject. So I have to equalize that out, and I have to raise the value up to the same age. Typically, appraisers go about $100 a year. So I calculated $5,300, raised the value by that. If we look at the square footage, the subject was 1,372 square feet. The comp was 1,471 square feet. So in this case, the subject was a little inferior to the comp. I had to reduce the value of that comp down to the value of the subject. Now, these are not square foot. How much is it going to cost to build this house per square foot? This is a perceived dollar amount, and it changes. This is why if you had 5 real estate agents or 5 appraisers into your home, the values would all be a little different, because everybody has a different perceived opinion of that value. So in this case, I had to take a negative adjustment. I had to bring the comp down to the subject. And so it went with all of the comparables. And at the bottom, the very bottom column, I found, I come up with a range of value. The low range, comp number 3, was $105,800. The highest value was $122,800, and that was the second comp. And so this gives us our range of value. If you said to me, I need to sell this home in 30 days, we need to be closer to 105. If you said, I have a little bit longer and I'm willing to condition this home, you could be higher towards the $122,800 price. In this case, I listed it at $124,900. The house was already in great shape. We reduced the price after a couple of weeks. She decided she wanted to move out of state a little quicker. We reduced it down to $119,900, and we received a full price offer on it. The comps, after they were all equalized out, it told me my sale price should be $116,900, so I was $3,000 off. Although we don't have a crystal ball, this is pretty scientific. So after we come up with your sale price, what are the next steps? So we're going to move forward in marketing your home. We're going to get it on the MLS. We're going to get it out on all those other websites. We're going to have the photography done. We're going to allow showings. We're going to screen buyers. Maybe we'll have to do an open house. Hopefully, all of our efforts create a purchase agreement within your guidelines. We're going to look at that offer, and I'm going to generate a net sheet. Now, a net sheet is, here's the sale price, here's the terms, and this is what you will walk away with. So you should know pretty close to what it is you'll be walking away with from that sale. Or, if you're upside down, meaning you owe more than the house is worth, you may actually be bringing a check to closing. So if we don't like the initial offer, let's say we don't like the purchase price or the close date, we could make a counteroffer. If the buyers didn't like our counteroffer, they could counteroffer us. And this could go back and forth any number of times until finally we come to an acceptance. So an acceptance is a meeting of the minds where the buyer and the seller agree on all of the terms of the contract. After we come to an agreement, there are a couple of areas of pitfalls. The first hurdle that we have to get past are the buyer's inspections. Every buyer, unless they specifically in writing waive their right to inspect, has a 10-day inspection right. Now they can inspect any one thing or they can inspect everything about the house. This, no doubt, will generate the repair addendum because they're going to ask for repairs. What we're hoping is that the repairs are a minimum. What we're looking for are major safety issues. If we find nicks in the countertop, that's the buyer's problem. What we're looking for is the inspector said that the electric panel is a huge fire hazard and it needs to be replaced. Or the roof is shot and it's going to be $12,000 to replace. So how do we deal with that? Well, we enter back into negotiations again. The buyer could say, all right, the roof is shot, I need $12,000. Seller, you reduce your price $12,000 and I'll take it as it is. Or you put a new roof on. Or maybe they'll assume that roof in the deal as it is. There's a lot of different things that we could negotiate on a repair issue. If we get through that, the next step is the appraisal. Now this is where the independent appraiser comes through the house to put that value on it for the bank. The house has to meet value, or it could exceed value, but it only has to meet the purchase contract value. The appraiser could also order repairs. We see this happen sometimes in FHA deals. So FHA says that the house has to meet a minimum certain guideline. If the house doesn't meet that guideline, the appraiser may say you have to put GFCIs in, or the roof has to have a minimum certain many of years of life in it, or broken window, you have to replace that. And if we get past that, then the wait begins. During the waiting time, the lender is working on processing the file. We're going to order and review the title work to make sure that we're being given a free and clear title. The financing is being processed, and we're hoping for underwritten approval soon. What we're waiting to hear are the magic words, clear to close. So when the lender gives us that clear to close, we will now set up a closing. At the closing, the buyer and seller both come together. The title company will present the documents. Both agents are usually present. Now with foreclosure, when the seller is a bank, sometimes the agent is there and sometimes the agent isn't there. Typically we see the lenders attend the closings. Title company presents the documents to each side independently. Each side signs their own documents. And then we talk about possession. Anymore, it seems like there's at least a 7-day possession time period in there. So after the closing, the seller retains the house for about 7 days, maybe longer, maybe less. And they turn the keys over at whatever is the agreed upon day and time. Typically with foreclosures, we could do possession at closing because they're always vacant houses, so that we don't have to wait for anybody to get out. And that is the entire process. Congratulations, you've made it through that whole process. If there's financing involved, that total timeline could be 4 to 8 weeks. Cash, we can usually speed that up just a little bit to 2 to 4 weeks. Sometimes there are inspections with cash deals, sometimes there are not. But as long as the title work is clear and ready to pass to the next owner, we can close those very quickly. Does anyone have any questions on that portion that I might answer? I'd be happy to answer questions afterwards too. Sure, so typically when I list a house, I've already had some sort of a relationship or communication with the seller, and I will order a PTR, or a preliminary title report. And that will kind of get the ball going to see if there are any liens on the property that we're going to have to be released. Maybe there are oil and gas leases we're going to have to work with. If it's a land contract that has to be cleared, we're going to have to take care of clearing all of that. We're looking for things like death certificates, or there's a number of things that we have to look at on the title, but yes, we do start those typically before we list the house. After we get the contract in from the buyer and we know who the buyer is going to be and what type of loan they're getting, how much, we can add them to the title work then. So, yes, and typically the sellers have their choice of title companies. Most agents have title companies that they work with, and so we tend to stick with those same title companies. Any other questions? Okay, I'm going to hand everything off to Margie, and she's going to talk to you about financing.
Everybody hear me? Okay, my name's Margie. I'm from Kellogg Community Credit Union, and I am the mortgage sales manager at the credit union. Amanda was supposed to be doing the presentation, but unfortunately she's out of town. She's camping, which is good for her. So I'm here to kind of talk about the financial or the financing part when you purchase a home or are trying to get pre-approved for a home. I guess I have to do the slides. The biggest difference, there's two types of actually properties. You can buy a property and it could be your primary residence, or it can be an investment property. So I'm going to focus on those two types of homes or purchases and types of properties. Your primary residence is basically a home that obviously that you live in. It's your primary residence. It's what's on the address on your driver's license. It can also be considered a second home, where if you have a lake home up north, that is also considered technically a primary residence because you are living in it as well. That is not considered an investment home. Even if you rent it out for a week, you know, you have a home up in Charlevoix, let's say, and you rent that out for a week, it's technically still a second home because it's considered a lake property. It has to make sense to be a second home. It has to be so many miles away from your primary home. The other type is the investment type property, and that was where you would purchase the property with the intent to have renters in the home to rent from you. It would not be your primary, it would be the investment home. So that's typically 1 to 4 units is a investment type home, a duplex. It can be a single family home as well, but obviously it's anywhere from 1 to 4 units. As far as the financing part of the two different types of properties, the investment home has 3 basic types of mortgages that you can qualify with on an investment home. It can be a conventional, which is the most popular Fannie Mae, Freddie Mac product. It can be an FHA loan, which is the government-backed loan, or an FHA 203K, which is a government-backed loan that it's kind of like a new construction where the house is in really bad shape and you're looking to do some improvements before you actually take possession or take the home over. The primary residence or second home products that are available are your conventional, your FHA, the VA, which is the Veterans Administration type loan, and then the Rural Development loan, depending on where the home is located. So you get a couple more options as a primary residence product for a mortgage, but again, most of the time there is financing for either type of property. So the biggest question we usually get is, what do the lenders look for when we're trying to get you pre-approved for the mortgages? The key points here, time on job. Obviously you have to be employed, which most people know that. They look for usually a 2-year job history. They would like it in the same line of work. basically they go back 2 years. So they would require either 2015, 2016, either W-2s or tax returns. They're looking for consistent income, obviously either going up or if it's trending down a little bit, they would just need to know why the wages decreased. But again, they're looking for just making sure that you have a job and you've had it for the last couple years. Obviously, the credit history and the score play an important part. They usually look for 2 traditional trade lines. The score, just an average score, usually the target score is 620 or above. That's not necessarily meaning that if you're below 620, you can't get a mortgage, but that's kind of the average score that most lenders look for. They also look for, obviously, your savings or what type of down payment that you want to do when you purchase the home. And you hear on the radio, there are several different products out there. Usually the minimum to keep in mind is at least 3% of the sale price is the minimum down payment required for either 3% or more for most of the products offered. So they're looking for that type of money saved, and then there's closing costs, which can depend on the area and the lender that you end up choosing. But they're going to look for savings or checking accounts with balances in them. The other factor when we're qualifying you would be the debt to income ratio, and this is taking your monthly credit card debts, car payments, any credit card balances that you maintain, and they only use the minimum payment on the credit cards. They will take that into account based on what the total monthly debts are versus your gross monthly income. And that does include your house payment, including the taxes and the insurances. And again, this is where the loan officer will go through with you, break it all down and run the numbers for you. Technically, normally you can go up to 50% is the guideline. So if it exceeds 50%, the debt to income is 50% of your gross income, then they are probably going to try to get you into a lower loan amount. But again, you can go into further detail when you have your loan officer in front of you. Financing differences, there are a few between the primary residence and the investment. As far as the investment, we'll start with primary because that's usually the most popular. Primary residence, you're looking as little as, like I said earlier, 3% down. You can have seller's concessions, sometimes up to 6%, and that's where Linda would come into play with the seller's concessions. If they're going to pay towards some of the closing costs. If you go an investment type home, the minimum down is 15%. And the reason for that is they want to make sure that you have some equity in the home because they're a higher risk product than they are of primary residence. Because as Linda was referring to earlier, you're in the house, you're maintaining the house. An investment home, you kind of sometimes are not able to maintain it as well. So in the history of the mortgage history with the investment type homes, the government and the FHA, Fannie Mae and Freddie Mac have decided that they want at least a 15% investment in the home. It can be more, but they at least usually 90% of the time they want 15% or more. And again, you can have seller's concessions on an investment property, but it's limited to 2%, where you can go anywhere from 3 to 6% on the primary residence. So there's a little bit of difference, and again, that's where your loan officer would be able to go through details based on the type of property that you're choosing. As far as the required documentation, with the credit union, in most credit unions, you're going to be required to join, which is a simple process. It's just a matter of opening up a savings account and depositing $5 because they want you to join the credit union. That's how you get an account number, basically, or membership number, and that's how you establish membership. As far as the income verification, like I said earlier, we're going to do 2 years of your W-2s if you're salaried, or we would do 2 years of your tax returns if you're self-employed or if you are on commission. And again, that's when you sit down with a loan officer, they will be able to identify what type of documentation that you would need, or even on the conversation from the phone. And they also require 30 days of pay stubs. So they want to show at least 2 of your pay stubs to show a 30-day kind of year-to-date average for your current pay. Bank statements, we usually go back 2 months on any type of checking or savings account. And usually if you have your investment or IRAs, usually they come in quarterly statements, so just the most recent quarterly statement on investment products or investment assets if you're planning on using those. We usually only require what you are planning on using to purchase the home is what we want to document. We don't want to get too much documentation from you, but again, the conversation with your loan officer, they would identify what you need to bring at time of the application. We're also going to require homeowners insurance on both homes, and that's when we probably would ask you who your current agent is. You probably have car insurance, so we'd ask, okay, who's your agent? We'll talk to them because you're going to need to insure the home at time of closing. And they would go over the differences between the dwelling amount and all that good stuff. But we would get at least the quote going because we need to make sure that we're giving you the correct monthly payment. Again, the retirement investment account statements, we'd ask for the quarterly statements on those if you plan on using them. If you pay child support or you receive alimony or child support income, we'd ask for the court documents or court papers for that. Show proof that you're current if you're actually paying child support, and vice versa if we're using it as an asset for child support or income. And again, the loan officer would be able to go through exactly what they would need as far as that goes. Divorce decree, if you've been recently divorced or in your home, your husband is, your ex-husband has the primary residence and you're buying a new home, the divorce decree states that he's, if he's staying in the home, then the divorce decree would help us state that he's responsible for that primary residence and the mortgage and all that kind of stuff. And again, we would require that at time of application and go through it with you. If there's any other documents that we would need, based on the conversation we have with you on the phone, we would let you know what we would need. But we try to just do the basic and try to make it as easy on you as a buyer as possible. We want to make the process very smooth and easy. So the biggest mistake people make, they get in an application and then all of a sudden they think that since the application's taken that they're done with it. And in this day and age, in the good old days, that was probably the case, but since the mortgage meltdown, things have changed drastically as far as how the mortgage process works. So we came up with the 10, obviously, things to avoid before buying a home or when you're in the process of buying a home. If you do not change jobs, become self-employed or quit your job. Obviously, circumstances happen within the time loan process. If you have a new job coming up, of course, we're going to use that and we get the letter of employment, et cetera. But if you can avoid changing anything until you close, that is great for the lender. Do not buy a car, truck, or van. Hopefully you can hold off on that because we're going to have pulled your credit report and all the debts that show up. That's how we're qualifying you. Try not to use your credit cards excessively or let current accounts fall behind. Again, in certain circumstances, we will do a credit update if need be, but usually once the credit report's run, we want to keep it as is and not have to run the credit again if something changes between the time that you apply for the mortgage and the time that you close. The money that we verified, don't spend it if you can help yourself, so you can set aside and use it for the closing. Let your loan officer know any debts that you have because that's going to help them set up the loan correctly so there won't be any surprises when it gets to the underwriter. Do not buy furniture on credit. Just basically what this whole slide is don't do anything with your credit. Do not originate any inquiries in your credit. Do not make large deposits without checking with your loan officer. And the reason for that, any type of large deposit above and beyond what your monthly income is or your pay, they just are questioning. They want to make sure that you didn't take out a cash advance on a Visa that would cause another debt to cause your debt to income ratio to change at all. So it's just documenting. If you do need to make a large deposit, it's not that you can't do it, just document it. They're going to want to, if it's somebody's, your mom and dad are paying you for something back, just if it's over, usually the general rule is $3,000 or more. So just keep that in mind. Do not change bank accounts, just try to keep everything as is, and then try not to co-sign for a loan in the process. Yeah, they're fine. I mean, what happens when we run the credit, we're going to get all the inquiries usually within the last 6 months. So we're going to know what you did, or you know what I'm saying, as far as that goes. If you have to do it again, we're not going to redo it because you had to inquire on a credit to answer your question. No. We will have the ones that have come up to the time that we inquired, and our inquiry will even be on there. But no, we're not going to be, what did you do? If you go into your shopping cars and they usually pull your credit at that point, but you haven't actually purchased, no, we're not going to have to redo the credit again for an inquiry. Correct. So frequently asked questions that we normally get. Should I talk with a bank before looking at homes? And my answer is no, you should not talk to a bank, you should talk to a credit union. We have to change that slide. Credit unions will get you can talk to credit unions in person, etc. So yes, you definitely should talk to a credit union and meet with a loan officer to get pre-approved before you are looking for a home. That kind of gives you an idea what range you're at, what the payment is, etc. That's huge. Do I really need a realtor when buying a home? Of course you do. Linda covered all that. The reasons why we would like you to have a real estate agent. It's just going to help you in the long run. Who pays the realtor fees when buying a home? Obviously, it's case by case, but usually the selling agent, sellers of the house do. But again, Linda covered that. Short sales, we don't really have short sales, knock on wood, too much anymore. That would be as if the sellers of the home were owed more than what they can sell the home for. Hopefully, the values in the last years have helped decrease that type of short sale. It was popular at one time. So what it is basically that the seller owes more on the mortgage than what the home is worth. Can I become a homeowner if I've had a bad credit? The answer is yes, you can do that. Just because your score is below the 620 does not necessarily mean that you are a bad risk. There's all compensating, they take into account all factors when they are underwriting a loan. We at Kellogg, we offer portfolio products, which sometimes doesn't, if your loan doesn't exactly fit into the Fannie Mae or Freddie Mac guidelines, we have a product offered that we can try to use it. It's called a portfolio product that if you don't qualify in all the parameters, we can still try to make the loan work for you. And this is why the pre-approval is so key, is so that we can see what category that you are in and what product we can offer to you. So, why KCCU? Because we were named the second healthiest credit union in Michigan. We're local. We give back to the community. Personal service, I think, is key. I've worked at a couple different banks before I came here. You get the personal service, you get somebody answering the phone, you get the underwriter local, everything's you can hands-on, especially as a loan officer, it's huge to be able to access the file. Time frame is also key with personal service. We have a 30-day or less closing time frame. We're going to try to get your loan and get you in the house within 30 days or less. We offer great rates. We're usually very competitive with the rest of the banks and the credit unions. Again, the terms, usually it's the 15, 30, 20. We have different options for terms. The fast approvals, all the mortgage decisions are made in-house. And then the other key point is that we do service the mortgage. So your payments will be made right to Kellogg. If there's an issue with the mortgage or with your payment, you can talk to somebody at our branches. And then we offer flexible loan options of the portfolio versus the conventional loan I was talking about. Whoops, I think that's it. So that is it. Does anybody have any questions? Everybody's going to go out and get pre-approved today? It's based on where the home is located, and there's actually a website that you can go on to. It's the rural development website, and you can put an address. If you're looking at a home, and the rural development it offers you less down payment. It's like 3%, and it gives you, there's an income requirement, and then there's an area requirement. So it's a loan that you need the right property to qualify. You can find out online if that is, but that's what the loan officer would do for you if you had an address in mind. But it allows you to go the 3%. And then get some closing cost concessions from the government. So it's a product that's going to give you a little bit less than the 3%. Instead of seller concessions, it'll give you other ones. So, but it's not a popular product, but it can work for some areas. So, but there is an income qualification. So a lot of people don't qualify because they make too much money. I'm sorry? Construction loans? Yes, we do those. We offer those. Those are... we can do like a 6, 9 month, or a 12-month build terms is what they call it, and we work with your builder, and you can sit down. Usually it's anywhere from 5% down. It just depends on the type of house that you're building, but we definitely offer them, and that's where you'd sit down, because there's so many variances to the different types but we do offer them, and we do work with builders, and they do get draws from us, and it's a one-time close, so it's actually a very good product that we offer. That we do not allow. We've been burned in the past with that, and it's funny, my underwriter, when I was understanding the construction loan, she's like, they won't let them, unfortunately, because we've been burned on a couple of them, so we do not allow that. All righty, well, thank you very much for your time.